Welcome, ladies and gentlemen, distinguished guests, and our ISS alumni to our ISS Annual Learning Festival. In the next 30 minutes, we will dive into AI in finance and ensemble architecture incorporating machine learning models and genetic algorithm optimizations for foreign exchange trading. The slide will be automatically sent to you who complete the feedback surveys at the end of this session. This innovative fintech work was derived from Intelligent Systems project under NUS ISS Master of Technology. The project teams are Mr. Aaron Quinn, Machine Learning Lead at ABB, Mr. Harry Chen, Data, AI, and Intelligent Automation Lead at IHH Healthcare Group, Mr. Leonard Low, researcher at Singapore University of Technology and Design, and Mr. Nirav Parikh from Citibank. Today, we are very honored to have most of the project members joining us here. They are Leonard, Harry, and Nirav. Mr. Nirav Parikh will be the main presenter. He is a professional product manager with deep experiences in capital markets, banking, including listed derivatives covering electronic executions, listed clearing in futures, options, bonds, fixed income derivatives. Nirav is also highly competent in designing business solutions using applied technology and years of experience managing and delivering complex business projects leveraging internal technology and external vendors. As a senior business director, he maintains deep interest in leveraging AI and technology in financial solutions, partnering with Citi innovation programs on projects including loyalty bonds, custodial asset tokenization, know your customer, KYC marketplace, distributed real-time clearing, and intelligent algos. He has been invited for speaking at various seminars as well, including Asia Trading Architecture Summit, Future Industry Association, and FOW Trading Asia. Now, please, let's welcome Mr. Nirav Parikh onto the stage.
Thanks, Sam. So good afternoon. This is straight after lunch, so I have the pleasure of trying to keep you all awake through this discussion. I think more importantly, many of our professors who taught us through the 2-year journey that we did through the ISS program are also here. So with due respect and humbleness, I'm going to try not to keep this in terms of a technical talk, but rather talk more about what we learned out of the project and what are some of the things that we would like to do going ahead, right? The details of what we did, we eventually published it as a paper, and the paper is now available online. So the links are out here. And for those of you interested in understanding what we did under the hood, you will find all the details. One of my colleagues will give you a sneak preview or just a highlight of that for 5 minutes, but really we can't do justice to the entire project details in the time we have. So we thought we would rather let you read that and focus on some of the more interesting observations that come out of it. Okay. So with that context set, not sure how many of you are from the AI stream. I was told that some of you all may be here who are not from the AI streams or may not be familiar. So the first slide just kind of is a very introductory slide. By the way, who from here is not familiar with AI at all? Right? I doubt it. Okay, very good. Everybody is familiar. So then we're not going to go much into detail other than the difference from classical programming to machine learning, as we know, is that in classical programming, you had the data, but then you needed to know the rules. And you programmed the rules, and what the machine gave you were the answers. right? Fundamentally, what has changed in machine learning is that you still have the same data, but the rules are the real mystery. We don't know what the rules are. And in the classical programming, you needed to know the rules in order to get the answers. But in machine learning, you provided the answers, and what it gives you are the rules. Right? Now, if you think about that in the context of a trading system or a trader, the most fundamental problem a trader has is one, more data that they can handle. So data is ample. In fact, it's probably more than what you need. And it is in their brains that they have these rules, right? The good traders, at least. And based on that, they make the decision. And then we provided them, in the olden days, various programs, etc., that allowed them to execute those rules, right? And so that's kind of what you see out here is we used to do. Now, what in this new model we do is you take the same data, but then you take the answers. Now, the answers can be either derived from the data, or the answers can be in terms of reinforcement learning, etc. The answers can also be subject matter input from the environment, whatever the case may be. But what you really want the algo trading system to do is to find out the rules that lead to success, if that makes sense, right? And so that's what the endeavor in today's day and time is how do you create ML-based trading systems that can competently understand how to interpret the data and figure out the rules that lead to success, right? Whatever your definition of whatever your objective is out there. This one is just an introduction of the ML trading system. You know, when you do projects, eventually you want to take your project to become a product. We haven't done that so far, but assuming that we were going to go down that path, the way we would try to productionize or productize this would be to say that an innovative AI platform which can be employed to rapidly analyze large amounts of data and to identify patterns and opportunities for trading in the Forex market. Now, our project was specifically in the context of Forex markets, but the solution architecture is not limited to the Forex market. It can be applied to any traded market, right? It's quite a generic architecture. It just so happens that Forex markets are one of the most liquid markets. We had access to the data, and so we chose to use that as the sample use case, right? In terms of what clients need, hedge funds need to analyze large amounts of data in a short time to identify price patterns. So, you know, the product matches what the clients need. But what these ML technologies can help our clients is to be able to cope with rapidly changing markets, because markets are never static. And so the data that is coming in the market is changing all the time, and you need a platform or a product that will very rapidly be able to consume that data, apply its learning, and come up with sustainable and profitable trading strategies. Right? So this, again, the endeavor is to create a product that has got the framework to consume data as it's coming through the market, and to be able to then figure out how to adapt or improve on the trading strategy. And then the usual, right? I mean, in the sense that, you know, quickly and efficiently means you consume the data, you find the patterns, you validate the patterns, and then you generate the trading strategies. So you need something that can run, let's say, overnight, and you consume data that's happening every day in the market. You consume the data, you find the patterns, you validate the patterns by running some backtesting frameworks, etc. We'll talk a little bit about that. And then you essentially generate the trading strategy that then the next day can be employed to trade, right? Now, there are many trading models. There are models that trade intraday. There are models that trade overnight. There are models that trade even less frequently, weekly. Our modeling has been based on daily trading. So the time frame that we have used in a project is trading once a day, right? But again, it's a question of scaling the product. There is nothing fundamental about it being a daily trading system. It can be crunched into an intraday system, or it can be expanded into a weekly or monthly system as well. Okay, so what have we done? So again, within Forex, there is a lot of data available, and we have used the Euro-USD pair. It is one of the most liquid pairs in the Forex market. Forex itself is a liquid market, and EUR-USD is very liquid. The reason being is we could get reliable data from multiple sources. But again, as I said, there's nothing unique about the system in terms of Forex or this particular currency pair. A little bit of technical stuff, not trying to get in too much, and again, I'll try and keep it to the more interesting side of things. the daily price data as we were getting it, and you will see that on a mean and standard deviation basis, there is a certain amount of trend in the data. And what we did was, what classic AI teaches you, or ML teaches you, is you got to make the data stationary, right? And that's what we did, and we made the data stationary. We will see a little bit later in the talk that why this was important for some things, but why, on the other hand, it was actually detrimental, specifically to the product domain that we were solving for. We'll talk a little bit more about that coming through. Similarly, labeling, right? I mean, we had a certain strategy for labeling. We put label counts. You will see that the label counts between buy and sell. Essentially, our labels were, should the system sell or the system buy, right? And you'll see that the label counts are more or less similar, and that is problematic as well, right? Because it's very close to random, right? And again, so there are things that we learned out of there. And these were the various features that we introduced, right? These were not necessarily feature engineering. They were feature engineering, but these are well-established features in the market that we used and we added into our data set. And again, we'll see why we did that. Let me probably talk about it a little bit out there, is to complement the data, the raw data that we had. It needed to be complemented with these features in order to introduce what we call as memory into the system, right? Because one of the problems when you make the data stationary is you take the memory out of the data, right? The whole idea of making the data stationary is to not have previous trends, etc., incorporated into the data. You make it IIS, I think it's called. We needed to introduce memory back into the data, and so we had to do a lot of feature engineering to get there. We'll talk some more about it. But before we talk about that, as I said, we wanted to give you a sneak preview of what our system architecture was, just so that you understand the next part of our talk. And for that, I'm going to invite Leonard, who is our technical guru, to talk about that. Leonard?
Hi, thank you, Nirav. Right. First of all, thank you everyone for coming down to hear our group's project. I'm very happy to be able to present our project alongside Nirav and Harry. So let's have a look at Algo ML system architecture to see how it works. So there are four main modules involved in our system. First of all, we have the data abstraction and feature engineering, which is done by the pre-processing module. So what this does is extracts the raw market data and then performs feature engineering to generate the features that Nirav have just mentioned before to be passed into the models to make the prediction. So next up, we have the main brain of the system, which is the action petition module. So this is where the system will make the petition for the user as to whether they should buy or sell for the next day. And then following that, we have the trader module. So what the trader module does is it actually can trade on behalf of the user in a more smart and informed way that mitigates risk as well as maximize profits for the user. And then finally, we have the optimizer module, which optimizes various parts of the system. The reason why we have this is because we have noticed that in various parts of the system, such as like the strategies in the action prediction as well as the trader module, it is mainly driven by hyperparameters that can be tuned. And we notice if you just tune these hyperparameters, it can significantly impact the performance of the system. So the whole point of the optimizer module is to find this set of optimal hyperparameters in a more smart and efficient way rather than traditional methods such as brute force, which may not be possible depending on how complex the strategy is. So let's have a look at the action prediction module. So one thing of note is that instead of adopting a single model approach, which you see in most ML projects where you just have one model doing the prediction, we have opted for an ensemble approach. So an ensemble approach consists of various models or strategies, as you can see here. So each of these models and strategies will output their own predicted value, which is then collated into an ensemble module to give the final prediction. So you might be wondering, why do we use an ensemble approach? What benefit does it have over a single model approach? So let's imagine this way. You can think about forex trading as though you're going to exchange money at a money changer. And then the most important thing before you exchange money is that you're concerned about whether the rate is good, am I right? So before that, you probably have done some research on your own to see whether the rate at this money changer is good. But what you have also done is you consult friends or relatives to get their opinions on whether you should change at this money changer. Is the rate good or should you change another money changer? So after you get all these different opinions as well as your own findings, then you'll make your decision as to whether you should change this money changer or not. So this is actually the principal concept of an ensemble strategy, where each of these models and strategies acts as an expert giving their own expert opinions, which is then collated into the ensemble model, which acts as the gatekeeper to give you your final predicted value. In the context of forex trading, actually, this is important because, as what Nirav mentioned, the market data can be volatile and very fast moving. So by adopting an ensemble approach, right, it actually can reduce the error that's caused by this noisy or fast moving data in order to improve the model performance. So after the user has gotten the final signal from the ensemble, from the action petition module, they actually can take this value and then trade on their own. But we wanted to go a step further in the project. Rather than just being a recommended system, we wanted to be able to trade on behalf of the users in a more smart and informed way. So this is the whole point of the trader module. So the trader module will take in the final predicted action from the ensemble model and then pass it through a money management strategy that we developed that helps to mitigate risks as well as ensure that the trade action it does is the most optimal in order to maximize your profits. So it will then perform the trade through the preferred broker API, for example, Oenda or whatever API you prefer to trade on. So unfortunately, in the interest of time, I'm unable to go into more details into the techniques we use for our data pre-processing or optimizer module. But if you're interested, the details are in the research paper, or we can leave it to the Q&A session, or even after the presentation, we are more than happy to answer your questions. But in the meantime, I'll hand the time back to Nirav, who will go through the results of our system.
All right, thanks, Leonard. Okay. Results are very subjective. And when you do projects, you operate in a perfect environment with a review to get perfect results, right? I want all of you all to take with a pinch of salt the results you all are seeing out there. They are factual, but they are under an ideal scenario. When you actually get into reality, various other variables come into play that then change the performance, the final performance of your system. But from a principal perspective, this is kind of how we looked at it. We're going to just share with you some, again, our paper has got all the details of model by model results and how the ensemble performs and all that good stuff. But just a couple of key things to highlight out here. We used real conditions in terms of parameters to the extent possible, right? So we used a $5 million this is for all the testing of the results. We used a $5 million capital. We used lot sizes that are reflective of what the market trading is. Like you cannot trade in half lots. They are more expensive. So, we did that. We had risk management parameters built into the system. So, you don't want to lose all your $5 million you want to put into it, hoping that the strategy will come back. You want to have, the ability to control how much capital loss you have. You want to be able to control per trade at what point you start taking profit on the trade, at what point you stop losing money on a trade. So all of this is important, right? The AI part of it, the decision prediction is important, but unless you don't package the whole thing into something that actually works in a real market, all you have is just a piece of software. And so that's what it is. The one interesting you will find is there are a lot of magic numbers in here, right? Magic numbers meaning, we chose 100, 100. Why 100? Why not 75? Why not 125? And that is itself both the art and the science of trading, right? Partly it comes from experience, but partly, as Leonard mentioned, we had what is called as a GA optimizer. It's a genetic algorithm which was used as an optimizer. And we build it in a way that it can be used to optimize any parameter in the system. So if we so choose, we indeed used it for sometimes optimizing the hyperparameters of the base learners. In other cases, we have used the optimizer to optimize the hyperparameters of the trading model, right? So your optimizer is, and specifically a GA optimizer is extremely versatile, and you can adapt it to optimize whatever you want. You can't optimize all parameters at the same time, but you can optimize several parameters concurrently. Okay, this is fine. This is the base learners that we had in the ensemble. And you can see the performance of pullback was one of the highest. And as you go down, you'll see the performance kind of, this is the prediction accuracy in terms measured by the net P&L, right? Now, it's just not sufficient to look at what the profit is, right? You need to also see what the risk is being introduced in the model, right? Because at the say you want to maximize your profit, but you want to minimize your risk. You essentially want the best Sharpe ratio. And you will notice, for example, pullback, which has got one of the highest P&Ls, also has one of the highest drawdowns. And so for higher returns, you're going to take much higher risk. And depending on the time frames you're trading and depending on where you run out of money, etc., you might find that you had incurred more risk than profits by the time you ended your trading strategy, right? So what you need to be cognizant when you are dealing with trading strategies is just don't look at one aspect of the problem. You need to concurrently look at the risk you're taking as well. It's the two in combination that gives you the most optimal strategy. Okay. So that was as much as we wanted to speak about what we have done. Details again are in the paper. We wanted to now share with you in the next 5 or 10 minutes that we have about some of the learning points and areas for further development, right? If any one of you are interested and want to build on the system, we'll be more than happy to tell you what we know and then let you all take it further from here. These are wordy slides, but I'll just try and keep to the key points. Feature engineering, right? Most important thing, I think adding new technical indicators to improve prediction accuracy is probably going to give you the most bang for the buck. Problem is then you have a very high dimensionality data set. You need to then do some sort of a feature reduction, etc. And then you're going to make sure that you reduce overfitting. The second one is probably even more interesting. Macro features to improve prediction power. So far, we've largely used just the trade price data. Right? The implicit assumption in our thinking was that price data is autoregressive and hence you can determine trends within the price data itself with a view to try and figure out what the market is likely to do going forward. Now, there are lots of people who will say that's impossible. There are lots of people who will say that's possible. The whole art of technical analysis is essentially based on the ability to look at price action and to be able to predict, what happens. But sometimes that's not enough. And so if we were to go ahead, what we would want to do is we would want to add macro features, things that are not directly related to the price action. Things are beyond that, the interest rate, the index volatility, and stuff like that, because those are important predictors of what the market is likely to do. And by incorporating that into your machine learning model, you would get hopefully better prediction power, right? Regime changes to detect dislocation, all that good stuff. Ensemble techniques to improve model accuracy. Again, as you add more data, as you add more base learners, your ensemble needs to get more sophisticated. Your voting method needs to be a little different to recognize what is the risk in each model so that you can weight the outputs of the base learners. And then explore methods to introduce signal conviction. This is more on the thinking that at this point we have a Boolean prediction output. It's either buy or sell. However, there is a certain amount of conviction under the prediction, right? You have a very strong buy signal or you have a very mild buy signal. There are ways to, get the prediction, to get what we call as conviction, to get the conviction level of the prediction and incorporate that into your trading strategy, right? For a high conviction signal, you might want to put more money for each trade. For a low conviction signal, you might want to put less money on each trade. So there needs to be some method of introducing signal conviction into the trading model. I think that would improve profits as well. Cash management strategy, Leonard touched on it briefly, but I've just put out here a couple of points of what a good cash management strategy needs to have. And again, this is one of those things. It is not necessarily AI based, but without a cash management strategy, your trading strategy would either not work or would be extremely risky, right? You want to optimize investment with available capital. You want to size the exposure to conviction. You want to manage transaction costs. You don't want to be trading every day, buy, sell, buy, sell, buy, sell, buy, sell. Even if you are right most of the times, or let's say 55% of the times, most of your money would be gone paying the broker for just buying and selling those trades, right? So you don't want to be managing your transaction cost to make sure that while on paper your trading strategy is profitable, in reality you're actually losing money. Risk management to the addition of stop loss orders. We saw that earlier. We had stop loss orders in that, and then adding leverage to maximize portfolio exposure. If you get your trading strategy right, and in the markets we say, if you are right 51% of the time, you are the winner, right? All it takes is 1%, as in 50 being random. You need to have something. Your transaction cost will eat up that 1%. So in reality, it has to be probably a little bit higher than 51. But then you can also use leverage to then leverage and amplify your exposure. Remember, leverage goes both ways. So you can amplify your profits, you can also amplify your losses. But those are some of the things that you would consider. We didn't do this, but there are ways to optimize the cash management strategy itself by using reinforcement learning, right? This is something we couldn't do, but this is something I would very much like to experiment, or would like somebody to experiment. We've laid out the structure of what the reinforcement learning model would look like for a cash management strategy, right? For those of you who know reinforcement learning, your agent is the trading system itself, the one that you're trying to optimize. The environment is the market. The policy is the trading strategy in terms of daily exposure. Your value is measured as daily returns adjusted for transaction cost. Very important you adjust for transaction cost so that you have a true representation of value. Your reward is the final cumulative P&L at the end of the trading plan, and your constraints are to minimize portfolio volatility, right? Means risk. So if you were to structure a reinforcement learning system along these lines, and basically use your trading engine itself to feed back into the cash management, into the reinforcement learning model, at least I think that you could get a good cash management strategy coming out of it. And a cash management strategy is, I would say, almost 50% instrumental in the success of your final trading performance, right? So while our focus had been all on the trading strategy, the cash management strategy, I think, is equally important. Okay, and we are almost out of time, but here are some learnings, things that as we went through the project, we came to realize, things that were not obvious when we started, are still not very obvious, but things that we along the way learned. Trade-off between stationarity and memory. I spoke about this earlier. Market data, price data has inherent trends in it. And that trend is itself very important in order to be able to extrapolate the next price action. But by making that data stationary, you're essentially taking the trend out of the data. And when you take the trend out of the data, you lose very important information that's embedded in the data, right? The data is a time series, it's autoregressive, you want that memory. And the way we did that was we compensated by introducing memory as features back into the model, right? So 30-day moving average, the momentum of the price, stuff like that, that essentially looks at historical data, crunches it into a number, and adds it back into the data set so that we have some sense of the previous history of the data available as a feature for the model to take into account. Okay? Had we only done stationary, probably our performance would have been even worse. Training label horizon and time series data. Now this is again, you typically want to take your label to be in line with what your prediction time horizon is. So for example, we had used labeling, which was a one-day difference in price. So when you have your training data, you need to label the training data with buy and sell. What we did was we took a one-day difference. If today's closing price is more than yesterday's closing price, it's a buy. And if it's less, it's a sell. Well, that was our labeling strategy. But as we went through, we realized that that's not the best labeling strategy. In fact, there is no, at least in my limited understanding, there is no need for your labeling strategy on your training data to match what your trading model wants to do. So for example, you can look at a 30-day prior price and say, if today's price is higher than what the price was 30 days earlier, then I think we are in a positive trend and I think we should buy, right? It's I think, equally valid to consider those sort of scenarios. Now, why 30 days, why not 15, et cetera, that all comes to your calibration, right? And maybe optimization to some extent. Always being careful you don't land up overfitting because that's the biggest risk in these trading models, is you do all this funky stuff, and all you get is an overfitted model that's very good at predicting the past and has no idea what to do in the future, right? So that's important. High accuracy is not the same as high profit. We spoke about that a little bit. You can get high accuracy, but it's not the same as high profit for two reasons. The first one I spoke about, transaction costs can erode a lot of your profits. But number two, conviction. If you get high accuracy for all the market moves that were tiny, and you get it wrong for all the times the market made a big move, your theoretical number of accuracy could be, let's say, 57%. But that 7% you got it right was when the market moved very little. And those other 43% of the times you got it wrong, the market moved massively against your prediction and you lost money. So you've got to be very careful that you don't, or rather that's why we don't measure our accuracy or our model performance in terms of the accuracy in AI, as we call it, as in the prediction accuracy. We take it in terms of net P&L. And all our optimization is done not with a view to improve the accuracy of the model, but rather to improve the final P&L that the model produces, right? So that's something, again, as we went along the way, we learned it. Transaction costs can change everything. We spoke about that. And then overfitting and market regimes. We spoke about that a bit as well. Overfitting, that's your biggest risk, right? It's very easy to delude yourself and think that you've got a great model. It's great only in terms of predicting the past, right? Which is an oxymoron, but you get the point, right? An overfitted model is a useless model. And market regimes. Your market data, your training data represents a certain market regime. That regime may not exist in the future. So for example, if you want to think about it in a practical sense, last 10 years, we've been in an environment of falling interest rates. Interest rates are falling. As interest rates fall, asset valuation automatically rises. And so you've been seeing largely a bull market through the equities market, but largely predicated by the fact that the interest rates have been falling. 3 months ago, we changed. The market regime has changed. We're now in an interest rising rate market. If you're going to use last 10 years of data to do your model training, you quite likely are going to get it wrong because it is not reflective of the market condition today, right? So you need to overlay meta concepts like market regimes, maybe add macro data into your model, what's the interest rate, what's the inflation rate, etc., to try and get a better model that works across various market regimes, right? So these were some of the things that we learned as we went along. And that's it. I think we're out of time and we've done with our stuff. Thank you.
Welcome. Any questions? Do anyone have any question? I will pass the mic to you, or you can shout from your seat. Yeah. One thing Nirav just mentioned, we go to the previous slide. I just want to add on a little bit. Nirav mentioned the trading label horizon. So use today's closing price minus yesterday's closing price to decide whether it's a buy or sell. So this is relative short-time trading. Short-term trading. So Nirav is looking at, okay, can we predict something we buy here pretty not that high, then in the future, few months, few days, few weeks, then it becomes higher. So this is actually a perfect study domain of reinforcement learning. So you take action now, but you will observe the effects, many steps in the future. So that's an area that was investigating.
Yeah, absolutely.
Yeah. Right. So, okay, I have a question. I used to work in a bank. Consumer side. So if I want to try this method in my bank, how should I start? What kind of organizational resources or engineering skill sets should I acquire for a proof of concept?
Anyone of y'all wants to take it? Okay, I'll attempt it. I'll say two things. One is many financial institutions or any financial institution worth its name is probably already indulged in this sort of research, engineering research, whatever you want to call it. You won't hear much about it. These are not companies that produce research papers, or they only produce research papers when their strategy fails, because you don't want to publish a successful strategy, right? So you won't hear much by way of research on this stuff. You'll find the odd guy like me who comes out, but that's because I don't trade. So I can talk about it, right? If I was trading and if this was indeed a profitable strategy, I would be busy behind my computer making money rather than talking to y'all, right? Due respect. That said, it is the DNA of the organization that's very important, right? If you are not a data-driven organization, if you don't understand technology, if your trading philosophy on your trade floor is one of gut instinct, experience, and stuff like that, if you're a macro trading house, then maybe this doesn't work. But if you are more of a quantitative trading house, if you are more of a trading house that is willing to experiment with new technologies, then some of this works. Now, you clearly need people who not only understand markets, you also need people who understand AI. And this is the biggest challenge we have, most banks like us have, is, when you bring those two people together, the two don't even speak a common language, right? So you've got traders sitting on one side, you've got your AI guy sitting on one side. The first guy can't stop talking about markets and trading. The other guy can't stop talking about models and ensembles and genetic algorithms, and within 5 minutes, the traders are sleeping, right? So you need people who understand both sides and to get them to talk. Once you get talking, things will happen. But it's that initial resistance of not having people to have that dialogue. I don't know if they answer that question.
Yeah,
but
thanks, Nirav. I think one thing
there was
here,
one question there.
Oh yeah, sure.
I'm Nagarajan. Just a small question here regarding the same. I want to combine his verdict regarding the how to trade, how to arrange the trade. You are talking about the time series. What about the risk factors? Because that's a place you are also talking about hybrid, the technology as plus the business come together and make some decisions here for the effective trading platform. Where and the challenge here is based on the market, what kind of risk factors we are talking about. And again, you also point out somewhere in the slides, the risk, the scoring, because each market has a different scores. We cannot able to have the same score for all the markets. How to define it in this complex ecosystem? Because some people, they will go with some traders, they know, they have their own policy to influence. They know what is happening because of their own mindset, historically how they book it, the trades. But some of when you go to the technology side, how to add the trend analysis or something like we are talking about, how to mix this trend including the knowledge together, make some effective system. Is there any things we can also do? Any model technology techniques is available? Because each trends is different. That's why you are telling enhancement. This one, some decisions is different there.
Sure, yeah. Sure. I think you asked 2 or 3 interesting questions interleaved in all of this, right? See, you can develop a system that's kind of an augmented AI, where it does not directly do the trading, but it rather provides you input to the trader to improve their trading, right? That's one way to design a system. That's not how we have chosen to do, but you could approach it that way. The second one, which I think is, by the way, and you spoke about some risk and all that, right? To me, that's where the cash management strategy comes in. An organization will never give its trader 5 million or 50 million or whatever the number is and say, go for your life and tell me tomorrow morning how it went, right? That's not how trading happens. So the organization, especially if it's your own money, it's a different thing. As long as your wife allows you to do it, go for your life, right? But if it's an organization, then you'll have constraints. The cash management strategy is where all those constraints get put in, right? At what level will you get stopped out? How much risk can you take? How long can you hold the risk, right? Which currencies we can trade, which products you can trade, all of that kind of goes into the cash management strategy. So this is your corporate risk control framework, if you want to call it that. And then finally, you asked the question that, are there models, traders trade, they are the experts. Are there models by which we can bring some of that expertise and embed into this trading system? And we've not done it, we've not even spoken about it, but there's something called as inverse reinforcement learning, which has caught my attention. I haven't looked at it enough. But the inverse reinforcement learning does the opposite, in the sense the environment, or you'd rather create the reinforcement learning system, but then you take the trader's action with a view to find out the motivation. So it learns what the system should do based on what the trader is doing, right? And so it forms the rules along the way. I haven't read much about it, so I will stop here rather than say something wrong. But look up inverse reinforcement learning if that's what you're after, because I thought that was very interesting in terms of being able to, because not only in trading domain, right? In many domains, you have experts who have this intuition, call it experience, call it intuition, call it hunch, but they know what to do, but they cannot articulate why they do those things. And I think IRL is a framework that would allow you to explore that potentially. I don't know, I hope I answered your question.
There's one aspect from the learner here is he mentioned this solution may be optimized for EU USD trends. So is it versatile or generalized enough to support other trends? I think this is also one aspect there.
If you train the model with that data set, right? You can't run this model trained on this data set on another data set. But the framework of the model is generic. So as long as you take, let's say you wanted to start trading SGD AUD, just as an example, then you would have to take the data from the SGD AUD market, put it through the same pre-processing, data cleaning, feature engineering, and all that stuff. Then you can send it to the model, and the model would then work in terms of it would train itself on that data set and be able to give you hopefully competent answers.
Thanks. I think this is also the strategy, the benefit of using computerized system. So the cost is very low. You just start up a new virtual machine.
First of all, I'm very curious about, because I saw one of the strategies that started with B at only a minus 0.3% pullback. So that seems like a perfect candidate for leverage. That's it. I'm just wondering, is it feasible to run a system like this? Like a small startup, just between two persons.
There are lots of people doing small startups. I won't name, but one of our common friends has a system that he's done on which he's an interface on his iPhone. And
really?
when we're having a bloody drink together, he'll look up his service and say, I just paid $70. As in, I just got the beer paid for it, right?
Okay.
It's possible to do that, right? I mean, and people are doing that, right? I mean, that's what I said. People who are doing it successfully won't talk about it, but people are doing it. But remember, leverage is a double-edged sword, right? So I would be very careful on leverage.
But, there are some people like Ernest Chan, saying one of the good perfect candidates is when you have low pullbacks. If I may, one more question. So, I don't understand that in recent years, this trading pair, particularly the euro-dollar pair, means heavily affected as U.S. banks are changing from being affected by LIBOR to SOFR. I'm just curious, so an algorithm like this can function, can produce such results even without knowing the macro environment.
Yes and no.
Can we leave this question after this session? We can discuss outside after the break. Okay. So next is I want to invite Harry Chan.
Thank you.
Harry Chan to go to the stage to give us some sharing about his learning experiences in ISS.
Sorry, you want this?
Okay, yeah. Thanks. I would like to thank USISS and especially the lecturers for the past 2 years. So I think that's the best, one of the best decision I made, especially that we went through that program during the COVID period, right? So we learned this AI and ML stuff during the COVID period, making the best time when we can work from home and study. It's really the applicability of it. You see, I'm from IT healthcare background, but I have a bit of some interest in trading. And after thinking about the data, whether we get some healthcare data, there's a lot of consideration, right? The PDPA, those things. Then why not we just try this data that is widely available, right? But I would like to mention that the practicability of the ML AI is something that is very wide, right? Even for me, with a non-finance staff, can be participating into this kind of project, right? So for the this project, we I think the lecturers they can see that some projects, if you are deep enough, it's worthy for paper. that is something, that is for us, is our own, like we feel like, hey, this is my first time also publishing a paper, so it's really, I'm really proud of it, right? And we do it in part-time basis, right? It's a 2 years part-time program, and it's amazing that we, with a full-time job, can still do something like this with a 2 years program. So it is like a testimony to the worthiness of the program and how deep we learned during that 2 years program with NUSISS. Thank you, Sam. Yeah.
Thank you, Harry. I think the one thing also, mentioned by Nirav is you meet different people from different domains, and the discussion and teamwork will spark new ideas, new innovations, and new products on it. Okay, last but not least, thank you, Nirav and the team, for this very insightful talk of machine learning for foreign exchange trading. Let's give them a round of applause. Thank you. So now, in the next 2 minutes, please take out your phone to complete the one simple survey regarding AI and ML. So after completing this survey, the presentation slide will be sent to you via email. Okay. For more information about this work, you can reach out to me via this email, or you can connect with the team directly through LinkedIn by searching their names. And after this session ends at 1:50 p.m., if you want to have more conversations with our VIPs, you can do it in the bistro on 3rd floor. Okay, so they will be staying here for another 10 minutes. Okay, yeah. So now, please take out your phone. Scan the QR code. Let us know more about your AI projects. Yeah, I will safeguard at the door. Nobody can escape after you, before you complete. Okay, while you guys are taking this survey, Nirav, you want to answer the question asked earlier?
Yeah, we can try. We can continue talking afterwards if you're interested as well. If I understood your question correctly, it was, can you trade in a changing macroeconomic environment using a model like this? See, it all depends, right? How much the macro environment has changed and whether that has fundamentally changed the nature of the trend in the market. At the end of the day, all these models are doing, when they're only looking at price action, is they're looking at trends within the price pattern. And the expectation is that trends in the past will continue in the future. But if the macroeconomic environment has changed, then the trends will also change. So that's why I said I would do by putting some macroeconomic indicators into the model so that the model learns. And when one of those parameters changes significantly, the model understands that old pattern is no longer the same. And hopefully that gives you a different prediction, or at least tells you that something's not right. So
Nirav, I would like to add some more on that. I think in our research paper, if you take a look in the references part, we also reference to a lot of other research paper, trading related. And there's this particular trading strategy where they always train at a 3 months rolling period, and they can prove it that they are profitable in every period, right? So as long as your training data is updated, right? Your features are updated as well. I think that is worth trying. Yeah.
Okay, thank you very much. Thank you very much for taking this survey as well. Okay, those VIPs will join me to bistro for the next 10 minutes before the end of the session. So you guys,
thanks, guys.
Yeah. Thanks, you guys. Yeah. Stay tuned for the 2 p.m. sessions, which is about healthcare and AI in healthcare. Okay. See you next time. Hope to see you soon again in ISS courses.